With the Federal Reserve cutting interest rates by 25 basis points, what can we expect in terms of short-term and long-term treasuries, as well as Treasury ETFs? Are they still worth it? Where should we be putting our money? Let's get into the video. Now, even though they cut it by 25 basis points, there's still possibly going to be more interest rate cuts along the way. It just needs to happen. Everything is too expensive. People want to stimulate buying in the economy again. It's going to be good for businesses, going to be good for first-time home buyers, and etc. So we're going to be going over two ETFs, which is going to be the iShares 0 to 3 month Treasury Bond ETF, SGOV. A lot of you are familiar with it. It's a great place to park your cash. In my opinion, one of the best places. It's an ETF that pays out monthly dividends, and it's also tax efficient because you don't have to pay your local state taxes on the dividends because it's coming from the US Treasuries. Now we also have TLT, which is the iShares 20 plus year Treasury Bond ETF. And these are going to be two very different vehicles that actually work quite well when complemented with each other because this is going to be long-term treasuries. So it's not really subject to these short-term rate cuts, but there are some benefits to owning TLT when the Fed is cutting rates. Now, of course, that's not going to be good for an ETF like SGOV because you're going to be receiving less dividends every single month because of its short maturities. Now, if we take a look at the dividends, it currently pays a little over 4% of a yield, paying out monthly, very similar to what you would hold in a CD, certificate of deposit, or even a money market fund or a high yield savings. But in my opinion, SGOV has worked out the best for me because of its higher dividend yield, and it just trades on the normal stock exchange. Now, with this rate cut of 25 basis points, we have already seen a lot of high yield savings, money market funds cutting their yields as well. SGOV is going to be no exception. It's going to have a lower monthly distribution, which for a lot of people, they might not care. 25 basis points really isn't that much. It's 0.25%. So you're still probably going to get around a 4% yield, but you're not going to make as much as you would. But that's not really what this ETF was designed for. It's not going to make you rich. It's basically just an inflation hedge, but of course, more money, the better. Now with TLT, it's a little bit of a different beast. You're going to get over a 4% dividend yield as well, paid out monthly, but the difference between TLT is it's going to be long-term treasury bonds. So this means that the ETF price is going to be subject to some risk, as we can see in the past 5 years when the interest rates have increased. That was not very good for TLT. Now, on the other hand, with SGOV, we can see that this ETF relatively stays around the $100 price point. You're not really going to lose any money, in my opinion, with SGOV, unless the US Treasuries, the IRS, they all default, go bankrupt, and that sort of things. So in my opinion, this is a great alternative to a high yield savings. I've placed my emergency fund into SGOV, but on the other hand, I also say that TLT is a good complement to SGOV because of one reason, and that's going to have some capital appreciation in the NAV if rates are cut, because it holds these 20 plus year treasury bonds in its holdings. And when the rates drop, these holdings are becoming more valuable. They're going to get more expensive. It goes up in value. And in return, it's going to cause the NAV of TLT to increase as well because those coupons, those bonds, they're just worth much more money. And if we get an extreme example, such as the Fed decides to cut rates by 50%, so it goes to about 2%, then this ETF is going to skyrocket in price. Now, if you want to play the interest rates, this is a good ETF, in my opinion. You're also getting that 4% dividend yield, and it's going to react much more slowly to these rate changes than SGOV, which has a very short-term maturity, which is why we do see stability in the NAV. And there's also an ETF called TMF. If you really want to play some short-term interest rate plays, this is a triple leveraged TLT ETF. So you can actually make a lot of money or lose a lot of money because it's 3 times leverage TLT. So if you do believe that rates are going to be cut even further, this could be a good ETF, but there's a lot of risk involved. Now we also have some TLT income ETFs. We have TLTI, which is the NEOS Enhanced Income 20 plus year Treasury Bond ETF. It does pay quite similarly to TLT. I think it's around a 5 to 6% dividend yield. This website shows 4.75% because it doesn't have a full year of trading just yet, but it's about 5 to 6%. Now it's going to be about 1 to 2% more than the normal TLT, so you are getting enhanced income as the name suggests. It does have an options overlay to help juice up the dividends. And we can see the same capital appreciation that we see with TLT if rates do end up falling. So this is a great income fund for a lot of people if they want a little bit more juice from TLT. And then they also have TLTW, which is actually from iShares itself. It's the 20 plus year Treasury Bond Buy Right Strategy ETF. And with this ETF, you are getting quite a big dividend yield of 16% paid out monthly. Now, with this ETF, you are going to see some erosion, as we can see with this ETF. You're not going to see too much in terms of capital appreciation. You are going to be capped on your upside in return for its 16% yield, which is absolutely amazing and kind of insane that it's able to get this kind of yield from TLT. But you are going to miss out on some gains if the Federal Reserve ends up drastically cutting the interest rates. So that is something to keep in mind. But we do have some options to play the long-term Treasury bond market. And the reason why I say TLT is a great complement to owning SGOV is because, as mentioned earlier, when rates fall, you are going to get less money out of SGOV. So it's going to be a little bit less attractive. While on the other hand, this is very good for TLT, which it's going to increase in price. As we can see in the past month, it's up 2% from that 0.25 basis points cut. So it kind of counteracts what's happening with the rates. Now, on the other hand, if the rates end up increasing for whatever reason, which is a possibility, we don't exactly know what's going to happen. But for example, let's say the rates increase, this ETF is going to drop in price. On the other hand, SGOV is going to increase its dividend yield. So it's going to have either an effect on the yield for SGOV or the share price or NAV or TLT, and basically counteracts the other one and what's happening in the rate market. I actually do own both SGOV and TLT. I bought 100 shares of TLT at around the $86 price point a while back. It pays out monthly dividends, it pays out for a little over 4%, and it's been pretty good to feel a little bit more income. It's for people who don't want as much volatility, while it does have some significant changes to the NAV compared to the SGOV, which pretty much doesn't move at all. It is going to provide a little bit more stability, and having these two ETFs in a portfolio, splitting it and split your emergency fund between these two ETFs, it could provide some good balance. And let's briefly go over SGOV. A lot of people say they're losing money somehow with SGOV. If you hold it for long enough, you're pretty much not going to lose any money. But for a lot of people, what they're experiencing is they're buying it at a price. Say they're buying it now at $100.65. That is going to be probably on the higher end of SGOV because it is going to drop when it pays out that dividend. And that's something people are not considering when looking at the total return for SGOV. They're buying it at a high price and then they're selling it at $100.40. And on paper, that is going to be a realized loss in terms of share price depreciation, but you are going to receive that dividend. And so far, the dividends have been paying about 35 cents per share every single month. And if you factor that in to the total return, you're actually positive. So that is going to be a huge misconception from a lot of people. But there are some other options if you don't want to see these fluctuations in share price for whatever reason, even though it's only a few cents. WEEK, it's going to be short-term treasuries as well. It's going to be tax efficient. It's going to be a little bit lower of a dividend yield due to the expense ratio being a little bit higher at 0.19%, which is why I do favor SGOV, but it's a great option and it has a similar total return to SGOV. We do want to keep that in mind because it pays out weekly. And if you're reinvesting those dividends every week, it's going to compound a little bit faster and pretty much match the total return of SGOV. And if we take a look at the share price of WEK, because the dividends that you're getting is weekly, it's going to be about 7 to 8 cents per share every single week. And because of that, you're not going to see much of share price volatility because it's resetting every single week. And it's going to maintain its $100 price point a little bit closer than SGOV. So this is another option. It's a great one. It's by Roundhill ETFs. And a lot of you are familiar with their income ETFs. And WEK is a great place to park your cash. And a lot of people do avoid these Treasury bond ETFs because you're not getting any growth. You're not getting any high dividends. It's pretty much safe. It's pretty much just keeping up with inflation. And that's why people avoid it. But I do think that if you have any cash reserves, plop them into one of these ETFs, TLT, Gov, Week. There's others, such as T-bill. I believe it's the US Treasury 3-month bill ETF. There's also BIL, which is very similar as well, but it's a 1 to 3-month T-bill ETF. There's a lot of great options. And if you're not familiar with these ETFs, there's a lot of articles out there. And let me know down in the comments below if you want some more alternatives to the ones we've mentioned in this video, which is SGOV, WEK, and of course TLT, which I strongly love in my portfolio. Of course, I can't recommend any one ETF or stock. It's going to be up to your personal preference, but TLT is, in my opinion, a great buy for my portfolio to help balance out the lowering of the interest rates. So it is at a low price point at $88 per share. We can see it hasn't been this low since early 2000s. And that is because we've seen this huge run up when interest rates were pretty much near zero. And when interest rates were zero, it was at $170. So it is half of its all-time highs. I do think if the Fed keeps lowering interest rates, we're going to see some capital appreciation with TLT as well, all while collecting a 4% dividend yield. Now, of course, in the long run, these dividend yields are going to change with the interest rates, but it's going to react very slowly because the maturity on these bonds are 20 plus years. Now, let me know down in the comments, where are you guys parking your cash in terms of Treasury bonds? Are these worth it? Let me know if you're buying more or selling your Treasuries due to the lowered interest rates.